G'day, I'm Anthony Landale, Managing Director of Equilibria Finance, and here today with me is Raj Ladher, one of our senior mortgage brokers in the team from the Central Coast. Raj, you work with a lot of first-time investors and investors growing a portfolio. There's a lot of different considerations. It's a different mindset, a different approach being an investor. How do you have those conversations with a lot of the investor clients you deal with around what's important and how to approach that?
For sure. The first thing I look at is what is the strategy of the investor. And for my first-time investors, they look at me thinking, what do you mean a strategy? It's, isn't it easy as just buying a property and it does its thing, which it potentially could do, but it could be a money pit at the same time. So the first thing that we look at is what's the strategy in terms of what are you trying to achieve? So capital growth is definitely the number one thing that most people will look at. And then what's the return on investment? So what's the yield? And so what's the rental income? We then look at that and then we then marry that up with what the repayments will look like. And then we will understand what the cash flow is. Is that positively geared or negatively geared? And off the back of that, then we can kind of build a structure to fit that individual. So if the individual has, let's say, $1,000 a month to hold this property from a cash flow perspective, we know what the minimum rental yields need to look like based on that purchase.
Yeah, so cash flow is absolutely critical with an investment. I guess the other element to investing in property is it's a different sort of decision-making lens. You're not living in the house. It purely is an asset, as you say, looking at both capital growth and a return.
Yes.
So there's different things you might be looking for in a location.
Correct.
What do you talk about with your clients around that? Close to schools, close to hospitals, infrastructure, stuff like that?
Yeah, for sure. So just going back on the rental yield is very important. So we'll find different capitals, cities will provide a different return. So Sydney is probably on the lower scale. We do find on the Central Coast we'll potentially get a slightly higher return on investment. Along with the option of building like a granny flat, which then increases that rental yield as well.
Yeah, so there's some core fundamentals around what to look for in an investment and a certain area, the rent, the capital growth.
Yes.
Is it an area that can be well tenanted? What are the vacancy rates like? And there's a lot of general data out there in that space as well at the moment, isn't there? How do people get into an investment? A lot of first-time investors might have decided not to buy a home. A lot of ongoing investors might have a current home. Yep. They've got to build a deposit. How do investors get into the market?
Yeah, good question. So we've got clients who, your everyday mom and dads who have got their home and now have built a bit of equity in there and are thinking now what's the next step? So that's probably most of our clients that will come through who are looking at you tapping into some of the equity, which then allows them to buy the property without using any of their savings as well. The other type of clients, as I mentioned, based in Sydney, it's quite expensive to live, but people still want to live pretty close to the city. So I do get a lot of clients who, the term is rent vesting, where they continue to rent where they want to live, but they invest in a property they can afford. Yeah,
that is becoming a lot more common. And people hear the word gearing and it gets thrown around. There's obviously some tax benefit with potentially owning an investment.
Yes.
Do you want to just share and explain with everybody negative gearing, positively gearing, what that means as a concept?
For sure. In short, a positively geared property means you will get money into your pocket at the end of every month or at the end of the financial year in which you will pay tax on.
So that's added as income.
Correct.
On your tax return.
Correct. And then negatively geared is where the property costs you more than your rent it comes in. So that's costing you money.
And that becomes a deduction on your tax return.
Correct.
Which is the tax benefit potentially from an investment.
Yeah, and the key thought on a negatively geared property is, can you actually manage that as a cash flow?
Manage the cash flow on the way through.
Yeah.
Thanks very much, Raj. Some great tips and considerations for any first-time or investors looking to grow.
Yeah, thank you.